Hey traders, Mike Sir here. Welcome back to part 3 of the 4-part video series where I teach you how to trade futures contracts. Now in part 1, I taught you how to trade the US stock market utilizing S&P 500 futures contracts and a trading strategy that can help you capture big trends in the markets. In part 2, I taught you how to trade the precious metals markets, specifically the gold market utilizing futures contracts and the relationship between the US dollar and gold. If you haven't watched part 1 or part 2 yet, please watch those videos first as it will give you a good overall understanding of how the futures markets works. So in part 3, I'm going to teach you how to trade the commodity market, specifically crude oil, utilizing futures contracts. Now oil is a very volatile asset class, and if traded well, it can be extremely profitable. For example, please check out one of my past videos where I profiled a group of oil traders who made well over $660 million in profits. Let's get started. Crude oil is a natural resource that is considered the single most important commodity in the world because it's the primary source of energy production. Now, the world's economy is largely dependent on crude oil that is refined to help power our cars, our planes, and our factories. Now, for traders and investors, crude oil is a global commodity that trades in markets all around the world. Both has spot oil, which reflects the current market price for oil, and via futures contracts, which reflects the price buyers are willing to pay for oil on the delivery date set at some point in the future. Now, there are two major oil contracts that are closely watched by oil traders. Now, in North America, the benchmark for oil futures is the West Texas Intermediate, or referred to as the WTI Crude, which trades on the New York Mercantile Exchange. Now, in Europe, Africa, and the Middle East, the benchmark is North Sea Brent Crude, which trades on the Intercontinental Exchange. Now, while the two contracts move up or down in the same direction, WTI's crude oil prices are more sensitive to what's going on in the US economy, while Brent crude prices are affected by the rest of the world's economies. Traders love trading crude oil as it's a good barometer on the state of the global economy. There are many factors that cause oil prices to move up or down, but like most commodities, the most important factor is simply demand and supply. At the peak of the 2020 COVID pandemic, the global economy basically stalled. There were no cars on the road, no one was flying, and manufacturing plants were shut down, and therefore oil prices plunge. Also, oil supply has a big impact on oil prices, and OPEC, which stands for the Organization of Petroleum Exporting Countries, is the single biggest influencer in oil supply. Now, OPEC, which is a consortium that is made up of 13 oil-producing countries, they basically control almost 80% of the world's supply of oil reserves. Now, they set oil production levels to meet global demand and have the power to influence oil prices simply by deciding whether they should increase or decrease oil production. In addition, anytime that there is any disruption in oil production due to natural disasters or political unrest in oil-producing countries, it would generally cause oil prices to go higher. Before I discuss the way to trade oil futures contracts, I want to let you know this video is sponsored by Iron Bean app. Now, if you're looking for a trading platform to trade futures, you should consider utilizing the Iron Bean app. It's a cloud-based platform that allows you to access trading strategies, over 300 plus built-in indicators, quotes, charts, detailed market information, and more importantly, give you the same user experience whether trading on your desktop or on your phone. Now, most traditional brokers have a separate website, desktop program, and mobile app that gives you varying degrees of information. With the Iron Bean app, all the information you need to trade futures is always at your fingertips. Also, since the app is running from the cloud, you're able to place trades, write formulas, pull up chart data, and execute strategies right at the exchange data centers, resulting in fast trade executions. Please click on the link in the description box below to download the free app now and start trading today. Okay, back to the video. Now, crude oil futures are very popular contracts for many traders and typically trades nearly 1.2 million contracts on a daily basis. Now, like the gold futures contracts, they are also a derivative contract traded on the Chicago Mercantile Exchange's Globex electronic trading platform and remain closely tied to the West Texas Intermediate spot oil price market. The way to trade them is through buying and selling the full-size contracts under the ticker symbol CL. Now, each contract size of an oil contract represents 1,000 barrels of oil. So, if oil is currently trading at $100 per barrel, the value of one contract is worth $100 times 1,000 barrels, which is $100,000. If you're day trading, you only need a margin of $500 in your account, while if you're holding the contract overnight, then you need a margin of $6,765. Now, if the margins are too high for you, you can opt to trade an E-mini contract, which is half the size of a full-size oil contract and represents 500 barrels of oil per contract. With an E-mini contract, you only need a day trading margin of $250 in your account and $3,383 in overnight margin. Lastly, if you want to trade an even smaller contract, then you can opt to trade a micro contract, which is 1/10 the size of a regular size oil contract and represents 100 barrels of oil. With a micro contract, you only need a day trading margin of $50 in your account and $510 overnight margin. As well, the full-size contracts are traded in 0.01 increments, which means that each cent change in the oil contract has a monetary value of $10. For the mini contract, which are traded in 0.025 increments, which means that each 2.5 cents change has a monetary value of $12.50. The micro contracts are also traded in 0.01 increments, so each cent change has a monetary value of just $1. Lastly, the contracts are traded monthly and trade nearly 24 hours a day from Sunday 6 p.m. Eastern Standard Time to Friday 5 p.m. Eastern Standard Time, with a temporary trading halt between 5 p.m. and 6 p.m. Eastern Standard Time. Before I share with you the trading strategy to trade oil, please take a moment to like this video, hit that subscribe button if you haven't already, and tap on the notification bell. You'll be alerted when the next video comes out for this 4-part video course series on how to trade futures contracts. Now, as I mentioned in my past videos, trend trading has been a very good strategy when markets are going either up or down over a period of time, particularly when there is a strong fundamental catalyst. Now, with oil, with the start of the Russia-Ukraine war and the war still going on right now, this has led to a huge disruption in the supply of oil and push oil prices higher. So the trading strategy for oil at this time is that since oil prices are still trending up, then we look for opportunities to buy oil. Now let's take a look at a chart of crude oil. So here's a daily chart of crude oil, and you can see here from essentially May 2021, oil prices have been steadily going up, basically hitting around 55 here and slowly rising. And this is when oil prices really skyrocketed at the beginning of March, the start of the Ukraine-Russia war. And you can see prices basically started going up sharply. You can see here very volatile, going up and down, but you can currently see right now it's currently about $113 per barrel. Now what I'm going to do is I'm going to look at lower time frames to look at opportunity to enter into oil. So here is a 60-minute chart or 1-hour chart of crude oil starting from May 2nd all the way to currently to May 17th. So let's draw some trend lines here to see what the trend of oil is. So what I want to do is just go right here, go to the lines. So we're going to draw some lines right here. So you can see oil prices are going up here, and then we'll also draw a parallel line right here as well. So you can see oil basically has been in a channel. So ever since, you can say right here, oil prices have been going up, a little bit of a pullback. And basically since the start of May 10th, May 11th, it's basically been trading in this range, right? Up hitting this level of resistance, hitting the support. So this would be an area for you to buy, hitting an area of resistance, hitting here back to support to buy, hitting a level of resistance here, and then hitting back here has a level to buy. So let me see here. I want to draw another line right across here. So you can see right here. So there is right now a pretty strong support level for oil around 100 and a little bit under $112. You can see right here, strong support. Here, hit here, hit here, hit here, and hit here has a support. So if there's any negative catalyst that could cause oil prices to go down, maybe perhaps hopefully the end of the Russia-Ukraine war, or perhaps there is a more increased supply of oil. So what we're looking for is initially for this trend line that I drew right here to break. That would be a first warning sign. And then if oil prices can really break below 112, that would signal that this uptrend is over and potentially a start of a new downtrend for oil. Thanks for watching part 3 of the 4-part video series on how to trade crude oil utilizing futures contracts. Now in part 4, which will be released next week, I'm going to be utilizing the Iron Bean app to show you how I look for trading opportunities in the S&P 500, gold, and crude oil markets. So please make sure you hit that subscribe button and notification bell so you don't miss out this important video. I'll see you all in the next video.